Hi, welcome to Wade into Wealth. I'm Chuck Wade. This is my brother Ethan with us, and we are approaching episode 100. We're not there yet, but we're getting there.
Where are we at?
Mid-90s. We on this day have recorded multiple episodes, so I'm having to do the math in my head, and I don't want to give you an answer. But you a fan of Olympic cross-country skiing?
I don't think I've ever
It's like
watched it.
it's like in the movie Airplane.
Wait, is that where they shoot the guns?
That is not. That is the biathlon, I believe.
Then nope. No, I don't think I've ever
just
watched
cross-country skiing. It's where they ski, but it's where they ski across. They just ski. They don't ski down. They're skiing on terrain for speed, and they're racing.
I don't think I've seen it.
I wasn't expecting to know, but it reminds me of the movie Airplane when the young child's in the cockpit and the pilot's just asking him all these questions. And the one I always remember is, Johnny, you ever spend the night in a Turkish prison? Do you remember that movie?
Yes, I remember that
it's a
movie.
great- such a good
I
line.
remember it.
Such a good line.
Isn't Kareem
Anyway.
Abdul-Jabbar in
He
it?
is, yeah. He is. He once said about that movie, didn't like acting in it, thought it was a terrible movie, but it paid for some really expensive rugs I wanted to buy.
There you go.
So anyway, there you have it. So you are not a fan of Olympic cross-country skiing, not yet at least.
Yeah, maybe the next
Fun to
round
watch,
of
though.
Olympics.
You have any idea how often they train?
A lot.
You can give the information. It's written down.
Well, you broke it down nicely.
Yeah, thanks.
Let's see. 860 hours a year.
The average Olympic cross-country skier trains for 860 hours.
What's that, roughly a couple hours a day?
It is. It is.
But almost 90% of it is spent in light intensity.
That's what I think is so interesting is that there have been studies done of Olympic cross-country skiers and many different athletes, the highest levels of athletes, and the amount of training time they spend at various levels of intensity. 89% of their training time is spent at what would be considered very light intensity.
Medium intensity is 6%.
6%. I mean, yeah, basically. And then 5% of their time is spent at the highest level of intensity. And
Which makes sense, because if the numbers are reversed, you're just going to injure yourself over and over again.
Right. And, having trained for some very long races in the past, I can tell you the majority of the training that is prescribed to me by my coach, Chris Hout, who we've had on the podcast before, is very light intensity. It's go as you feel. Now there's usually 1.5 hour a week that is some sprinting. I hate that.
Yep.
Think of every excuse I can find to skip that and then just suffer. Let's just suffer through it. But the point is, for the highest levels of success and growth to be attainable, the process has to be sustainable.
Look at that.
Yeah.
But it makes sense, because I always like to equate investing to losing weight, which is there's always a new pill or a new fad that'll claim to lose double the amount of weight in half the amount of time. Unlikely to happen, and even if it does, it's not sustainable. Your doctor, I don't know if they'd still prescribe lean protein anymore, who knows? But lean protein, whole grains, fruits, vegetables, and if you have a dog, walk them around the neighborhood overnight.
Overnight, the whole night, all night.
Just
You could.
at
I
night.
mean, I don't.
Excuse me.
I think
not overnight. That'd be
brisk
long.
20-minute walk will be okay.
Yep. So back to
anyway.
the analogy, you will lose weight, but it's going to happen over time, and it won't happen overnight. Although, unless if you do walk the dog all night long,
It may happen quicker.
speed up the process.
May speed the process up. But is it sustainable?
It's
Probably not.
Exactly.
Because you're going to be exhausted because you're not getting any sleep.
That's right. Therefore, set yourself up for failure.
Yep.
But with investing, there's always a new idea or a new concept that'll make you a millionaire overnight. Also, not sustainable. You have to have good investments that are diversified with a disciplined approach, and you'll build wealth over time, but not overnight.
It has to be sustainable.
Yep.
And we're just talking about investing. This is a personal finance investing podcast. But again, this is applicable
It's with
just about anywhere else.
And in finance, it's with investing. It's with paying down debt. It's with trying to build up your wealth. I think a trap that some folks get themselves into is setting a goal that is. I like setting goals. We set a lot of goals.
Well, it's important
for our team.
It's important to set goals.
But we also have to set challenging but realistic goals. Because if your goals are unrealistic, you're just not going to, no matter how hard you work, you're not going to achieve them. And having goals that you know that you're not going to achieve, even though you may, say, well, shoot for the moon, you'll miss. If you miss, you'll land amongst the stars. Sure. But if you're nowhere even close to achieving the goals because they weren't realistic to begin with, how likely are you going to be to continue setting goals?
That is important. I'm going to differ slightly because where I see this being an issue is comparison. Comparison that we often get into. Now, that may be that we see something or see an investment or someone tells you, hey, look, I made all this money on this investment.
Yes.
Okay. Well, that starts to get you thinking, well, or look, I made this much, or you're seeing, well, this is what the index made last year. The index made 23%.
Yep.
The S&P 500 had a great year. And you think, I only made 8. I only made 9%. Why? What's wrong? What's wrong with my investments? Why don't I have that portfolio of investments? Or I see my friend made this much last year. I saw this investment, this cryptocurrency online. I see people making all this money. Why aren't I doing that? And that's where I see the problem, because sometimes we start to get a distorted view of the reality we should be seeking. And with investments, what I think is most important, and this comes from the book, The Psychology of Money by Morgan Housel, highly recommend. It's a fantastic book, but that our goal should never be to achieve the highest returns possible, but to seek the returns we can sustain for the longest time possible. Meaning, we don't need to be trying to beat the market. We need to be seeking a return that will allow us to stay invested for the longest period of time. And the period of time that we're in right now is a perfect example. It's easy to stay invested when the market's going up.
Everyone stays invested.
Everyone stays invested. People invest more money when the market's going up. But what about right now? Everyone's taking a punch this year with their investments.
It makes people take a step back
Right.
and think, ooh, should I actually save this money, or am I going to put this $10,000 in and it's going to be worth $9,000 the day after I put it in? It's possible. But to your point, which is chasing what we hear from other individuals or on TV, chasing returns sets yourself up for failure.
Yes.
Because just because an investment made 23% last year doesn't mean it's going to make 23% the next year.
No.
And oftentimes we see the investments that have the strongest year sometimes don't have such a strong year the next year. So if you're constantly trying to chase and be reactive to what's happening, you're going to put yourself at a disadvantage because the markets are always forward-looking. And trying to get what they just did doesn't mean that's going to necessarily continue into the future.
And something that is not the easiest thing to just think about, it's made easier with some experience, is if you think of, how am I going to feel if I make 8 or 9% this year? Okay, you'll feel fine.
You won't think twice about it.
How am I going to feel if I make 20% and then 25%, but then my investments go down 40%? How am I going to feel with a 40% loss? An aggressive portfolio is certainly going to have aggressive gains when things are going well. But in turbulent markets, it is likely to have an aggressive decline.
You are compensated for the amount of risk that you take. So what that means is the more risk you take, theoretically, the better returns your returns should be over time. Correct. But it also means that in the downward spirals, you're going to participate in those. And chances are you're going to participate in them very much so.
Yeah.
It doesn't mean that you can't be invested in that way. It just means you have to be willing to deal with the ebbs and flows that type of an investment strategy is going to provide you with.
Amazon's been a darling of the stock market for some time now.
Not this year.
There was a time this year it was down almost 50%.
Yeah. Yep.
And so...
Does it mean that's a bad company? No. It doesn't mean that if you invested in it 10 years ago that you still haven't made a ton of money. You still have. But does it mean that if you invested in it at the beginning of this year that you've made a lot of money? Nope. It means you've lost a fair amount of money.
Right.
But it doesn't mean that it's a bad investment.
No. And so what you need to consider is the kind of returns you can sustain. And that's where putting together a plan around your finances, looking at anticipated dates of retirement or anticipated dates for goals that you have laid out, looking at what you already have saved, what you have been saving, what kind of liabilities you have, can help you arrive at the kind of investment returns you should be seeking.
And you have to know yourself.
Yes.
Because we talked about maybe a couple weeks ago now, or probably a month or so now, because time goes by so fast, the client who checks their account balance twice a year. And if you know that you're that type of person and you're comfortable with the fact that the market's going to go up and down and you're not going to watch it every second of every day, or you're not going to log in and look at it once a day, then if you know yourself that that's not going to bother you and that's not going to keep you up at night, well, that might be okay for you. But if you're the type of person who I see an investment go down 10% and I immediately think I need to get out of that,
Right.
or you're going to log into your account 4 times a day and get bothered and upset about what's going on when the markets are going down, that may not be the best fit.
No. So it's worth spending some time with and being comfortable that when you are investing money, you should be seeking the kind of return that is appropriate for you, not anybody else.
Mm-hmm.
What about debt reduction? We talk about investments, okay, about growing money, because the money tree doesn't, to my knowledge, exist yet. At least I don't have one in my yard.
Nope.
I have crabgrass, but I don't have a money tree. Debt reduction. Let's say you have credit card debt. You probably want to get rid of that, and you set a goal to get rid of it. Well, what if you begin to put every single excess dollar towards paying the cards down? Chances are your balance will decline. You'll owe less on those credit cards.
Well, for a period of time.
What happens
until you have an unexpected expense?
Car breaks down or an unexpected expense. If you haven't been saving any money, if you don't have any savings, if you've been focused so aggressively on one single task, what happens?
Yeah, when that unexpected expense comes up, you put the credit cards back on it. That's why when we talk about an emergency fund, you need to make sure you have that emergency fund before you start doing anything else, because that emergency fund is the fallback plan for when those unexpected expenses come up to help prevent you from having to use debt and credit cards further.
Mm-hmm.
And to the point, the whole point of this podcast, which is your goals for it have to be attainable. You can't just put every single cent that you have coming in that month towards paying down your credit card debt, because what's going to happen is you may make progress over 2 months, and then something's going to come up and you're going to get distracted, and then you may not get back to paying on those credit cards again.
And you may have erased all your progress.
Correct. It won't take long to erase that progress.
Nope.
But setting up a sustainable path where you're setting aside a portion of what you have coming in, knowing that the goal is to pay it off in a year, or maybe it takes 2 years, as opposed to trying to pay it off in 2 months, you're going to be far more likely to achieve that goal and find that success.
Except that it may not happen quickly, but that by chipping away in smaller increments and being consistent, your odds of success are that much greater. There's a gentleman, his name's Chris Nikich, lives in Florida. He has Down syndrome, and he became the first person with Down syndrome to complete an Ironman event, which is a very long swim, bike ride, and then running a marathon. And his slogan is 1% better. And his goal is to become 1% better every time he trains. And you can apply that anywhere, and it makes total sense. And if you can just go out, try to get 1% better every time you do something, just try to consistently improve just a little bit over time, that adds up. You go get 1% better every day, you've made 365% over the course of a year. And that's a heck of a year.
It's powerful.
So, any final thoughts, my good man?
No, I think that's a great area to leave off on.
We will return with Wade into Wealth. See you next time.